Welcome back to CFI, Credit, Finance, and Investing. And today we're going to talk a little bit about credit cards. So, credit cards are something that most people's parents or friends or family when they're younger will warn them about, but everyone seems to need one. And why is this? Well, credit cards are like tools. And in this particular case, let's take a knife. A knife can be an amazing tool. It's used very frequently for a lot of different things. I used to carry one when I was working on rental properties every single day, because there's always a need for one. But just like a knife, which can be a tool or it can be something that harms you, credit cards have benefits and dangers as well. So quickly, let's talk about some of the dangers that credit cards may have. The first thing that seems to happen is when someone gets a credit card, it's easy money. It's an easy way to spend money, to acquire goods, and a lot of times people will spend that money without thinking about what they have to pay back. So you can get trapped in debt. It can ruin your credit if you do not make your payments on time. And some credit cards, by the way, do not report to credit unless they're reporting late payments, because there's a cost associated when they report to credit. So you have to understand what your credit card is and make sure that you are getting the benefits that you're looking for. And one other factor about credit cards that can be a danger are they are very easy to use. All you have to do is swipe that card, type that number, tap the card, whatever it is, and that money is out of your account. You have the goods and you walk away, and it's easy not to think about the payments. The benefits, though, of a credit card can outweigh the dangers if you track the details and you know the details and understand what you're getting yourself into. So, for example, credit cards can build credit. If you're looking to build credit, I would recommend a credit card over a car payment, simply because it's a much lower amount, it's easier to manage, and you're not stuck with it for a number of years if you manage it appropriately. Another thing is credit cards are what we call in the business other people's money. It's not money coming out of your account. Now here's where that comes in handy. When you go to a gas station and you make a purchase for gas, they put a hold on your credit card or your debit card, depending on what you're using, for a certain amount of money. Generally, when I go to a gas station, it's about $175 that they put a hold on my credit card. Now, that may only hold for a day or two, and it's reserving a certain portion of the money so that you don't have the availability to go spend it. And if it's on a credit card, that's not a big deal. If it's on a debit card and you don't have a whole lot of money in your bank account, that could limit what you're able to spend on something else like groceries or bills. So that's the nice thing about a credit card. Now, and credit cards also have sometimes insurance pieces built in, and there's a couple different ways this works. So for example, one form of insurance would be you have the ability to dispute a payment. If you are not given the goods, if you buy something and it's not actually delivered to you, say from an online vendor, you can call your credit card company or go online and dispute that payment so that you can tell them, I never received the goods that I was promised, and then you are actually not charged for it. Another way it can be a form of insurance is if someone steals your credit card number. If someone steals it and buys things on your credit card, you can again dispute that payment and you are not charged that money. That's happened to my wife a couple of times where she has been charged, someone has charged $1,200 or more on her credit card because they stole her number from a restaurant or somewhere else, and she was able to just dispute the payment and walk away. If that happens with your debit card, you have to fight the bank because the money comes straight out of your account, and you'll have to prove to the bank that that is not you that spent that money, and it creates another hassle. So by using other people's money and living and working within the guidelines of the credit card, you're able to have some protections. Now, another couple of types of insurance that come with credit cards sometimes are car rental insurance, where they will actually have a rental policy so you don't have to use your own policy for that, or you don't have to buy insurance from the rental car company at a significant cost. And another way that they do insurance sometimes is travel insurance, where if you're not able to, and this is only on certain credit cards, by the way, so you need to look at your credit card, but sometimes they will have a travel insurance where if you're not able to go on your trip because you get sick or something happens, your credit card company will pay for it and reimburse you for the trip. Kind of a cool feature. One other insurance model that they do have on, again, only some credit cards are purchase protection insurance. On that purchase protection insurance, you're able to, if your product is damaged or lost or stolen, they will reimburse you for that product. That happened recently with my wife. Again, we had a bike that I didn't mount appropriately on the car. It fell off the car and was stolen by someone, and the credit card company reimbursed us for that bike. So a couple of tools that are very cool by the credit card. One final thing that I have used on credit cards also is some of them, and again it depends on the card, will extend a product's warranty. So if you buy a product that has a manufacturer's warranty, a lot of times the credit card will take a 1-year warranty and double it to a 2-year warranty, and you're able then to have that extra protection on your credit card without paying for an extended service plan. I have used that a couple of times on my credit cards. So let's get into how credit cards are managed. And let me turn on my screen real quick. And you'll see here that the interest rates are really what determines how much your payments are on a credit card. As interest rates have gone up, credit card interest rates have gone up because they're adjustable. There are not fixed rate credit cards typically. You may find some, but the general credit card is not a fixed rate card. And the median average card currently, as of April of 2024, is 24.37%. Now, that is a very high interest rate, and you don't want to be paying that rate for debt because it'll be very hard for you to get out of it. Now, the way that credit cards are determined, or the interest rates on credit cards are determined, is generally by your credit score and the type of credit card that you get. If you have a better credit card, or a better credit score, you can shop around and find better interest rates on credit cards. Now, the way that credit card rates are tracking is generally they follow the Fed funds rate, and it'll be short-term rates. And then, of course, they add a margin, and that margin is how the credit card companies make money, is they borrow money from the Fed at one rate, or they borrow money from, in certain banks, they'll borrow money from their depositors, and they lend it out to the credit card people, the people that are borrowing money on credit cards, and that's how the banks make money. So the other benefits about credit cards are you get rewards and balance transfer offers and certain perks that you can take advantage of. My general recommendation is don't spend money on a credit card that you can't pay off that month. Now, sometimes emergencies come up, and that's great, but when you spend money on a credit card, you have to understand that you will be paying a lot of interest, over 20% generally in today's market. So if you look at the average rates on different types of credit cards, there's a variety of cards out there, and there's a variety of people that offer credit cards. But this chart here is from lendingtree.com, and they take an average of, or they take surveys of different credit cards, and they look at different types of cards. So if you look over here on the left, we've got things like zero balance transfer cards, or no annual fee cards, or reward cards, or cashback cards, all these different types of things. And the interest rates on this chart range from a low of 13.74% for low interest credit cards to 27% for secured credit cards. Secured credit cards are generally the type of card that you have to actually send them money, and then that becomes the amount of money you can spend on a card. Now, people say, why would you do that? Well, some people have bad credit or no credit, and they're not able to get a standard credit card, and secured credit cards are a good way to build credit, again, understanding that it's a tool. What I would recommend with a secured credit card, if you're not able to get a standard card, is number one, make sure they report to the credit agencies. Secured credit cards, I have seen those specifically not report to the credit agencies, but that is the only benefit that you're getting in using a secured credit card, is an opportunity to build credit and then to go to a different card once you have built up enough credit to be able to do so. Now, when I'm looking at credit cards, I'm generally not getting into the low interest credit cards. I'm not using this as a financial tool that I'm getting a loan from. I'm using it for all of the other benefits that we talked about earlier on. So the credit cards that I generally will get are airline points cards or hotel stay cards. And if I'm able to stay at a hotel for free several times a year, great. Or if I'm able to have someone else stay for free at a hotel, it just saves us money over time. Or if I can take free flights, then that's something that becomes a tool for me. But what I really want to talk about is the credit card minimum payments, or how to pay off credit cards, because that's something that a lot of people struggle with, especially as they're learning how credit cards work. Now, the chart that I have up here right now shows how a credit card payment is usually calculated. So, for example, and this is, you'll see it's very consistent, but American Express on most of their cards, and I have to qualify with American Express because some American Express are balance pay cards where you have to pay off the balance every single month. So again, understand what you have. But with a lot of American Express cards, you will pay 1% of the balance or $35, whichever is more. Bank of America is the same. Barclays is similar. You'll see that some of these, like Credit One, has a 5% of the balance or $25, whichever is more. You get down in here to Discover, and they have several different options. USAA and Wells Fargo have several different options. So for the sake of this video, we're going to typically use 1% of the balance or $35, whichever is more. And I'm going to come over here to bankrate.com in this particular video for calculating the minimum payments. And I want to show you this so that you can understand what a credit card payment can look like if you only make the minimum payment and how that can affect you financially. So for example, right now I've got this in here at $1, but let's say someone has a $500 balance on their credit card. And as we saw, the minimum payment or the interest rate on these starts at about 14%. So let's take 14% as the lowest payment option. And let's say that the minimum payment method is interest plus 1% of the balance. And as we saw over here, that's a lot of them, 1% of the balance or $35. So let's just take that. And on $500 is calculated. And if you have a $500 balance with a 14% interest rate and you pay the minimum payment, it'll take you 43 months to pay that off, and you will pay $136 in interest on top of your $500. But like we know, 14% is the lowest. So let's actually take this up to the average of about 24%. Calculate that, and for the privilege of borrowing $500, it'll take you 56 months to pay that off, almost 5 years, and you'll pay $332 in interest on top of your $500 balance. Now let's take that up to $1,000. And I'm just going to run a couple of scenarios here so that you can get a feel for how this looks. So if you have a $1,000 payment, you'll notice that because of the interest rate, it amplifies the amount that you pay as a percentage of what you owe. So in this particular case, 125 months over 10 years making the minimum payment, and you'll pay over $1,000. So you owe $1,000, but you'll pay $1,332 plus the $1,000 that you owe. So for borrowing $1,000, it'll take you 10 years to pay it off, and you'll actually pay $2,300 according to this calculator. So what we need to look at with credit cards is this something you want to get yourself into? Why would anyone ever use a credit card if you're going to pay so much interest? Well, because if you can afford it and you can pay it off, you get those protections. So in this particular case, let's say that you've got a $1,000 balance and you pay $1,000 off, well, you're going to pay $20 in interest. And you have to ignore this part up here because of the way the calculator works. So is $20 in interest worth the benefits? Maybe, but here's the other piece. Most credit cards give you a grace period, and that grace period means that if you pay your debt off within so many days, and on some cards it's 30 days, other cards it's 25 days, you have to check your credit card documentation, but if you pay it off within the grace period, there is no interest at all. And that's where credit cards can become a much more valuable tool. By managing the credit cards and understanding what you're getting yourself into, you get basically an interest-free loan. You're able to go out and have other people's money pay for whatever it is you're buying. You get the insurance protections, you get the fraud protections, you don't have holds put on your personal money, and you're able to use that money to pay for goods as long as you're paying it off within the grace period. So understanding what you're getting with a credit card, understanding what the tool needs to look like and how it should be used, can afford you the ability to go out and utilize this tool to get rewards, to get the protections without paying for those. And if you need to have if you need to have the credit, meaning you're going to carry a payment for a couple of months, that's okay. It's okay to pay a little bit of interest for the benefit of having that, but you also want to make sure that you don't get stuck in the trap of being in excessive debt and having 100 or 200 months of payments simply because you didn't understand what you were getting yourself into. Thank you for being here. Thanks for watching this video. If it helped you at all, please give it a like. If this type of content helps you, please feel free to subscribe. And if you know someone that could benefit, please share this video with them. If you have any other questions or any other videos you'd like to see, please put those down in the comments below. Thanks for being here.